Hey guys, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and author of Australian Real Estate Investing Made Simple, which has gone bestseller. Thank you very much for that. Today what I'm going to cover is how to correctly structure and automate your property portfolio in 2021 with the aim of, number one, paying down your house in record time. So, because obviously your house is bad debt, so you want to have that mortgage discharged as soon as possible. But also, how do you automate the whole thing passively? So there's little involvement from your end, but you're maximizing everything. You're structuring your portfolio in a way that every property is standalone, no cross-collateralization, different lenders, different trusts, and you're offsetting your bad debts, which is your home loan. And I'm also going to cover a lot of terminology and jargon as well. So it's going to be a really cool video because I'm getting a lot of emails and inquiries and phone calls about structuring and what does it mean, what's the difference between a line of credit and equity release, those kind of questions. Personal disclaimer before we get started. So obviously I haven't met you before, I don't know your financial situation. So before you do anything, please seek independent financial advice from a qualified individual. This is purely just educational only in nature. This is not considered as investment advice. My background, just very quickly, is that I'm a real estate agent, a mortgage broker, and I had a background in banking and finance. But most important thing is I'm a property investor myself. I've got a large multi-million-dollar property portfolio here in Melbourne. So I'm doing all the things that you guys want to do, and I've been doing this for over 20 years now. So a lot of time in the industry, working in the financial services sector in different companies, but also implementing all the stuff that I'm teaching as well. And so, one of the key things you have to always consider is the person that's giving you the information, what's the realistic achievements that they've got? What have they got behind them? Never seek advice from people that are broke, okay? Never seek advice from negative people. They've got a problem for every solution. So always get advice from people that have achieved exactly what you want to achieve. And whether that's in real estate, stock market, whether it's in tennis, whether it's in, gymnastics, golf, whatever your thing is, always get advice from the experts in the industry that have achieved that level that you want to achieve. By the way, if you want to get a copy of my book, just go to bookonfinance.com.au or jump onto Amazon Booktopia, any good bookshop out there, including eBay, and get a copy. My second book also has gone #1 bestseller, Australian Real Estate Investing Made Simple. You can get that on my website, which is realestatemadesimple.com.au, or any good bookshop, Amazon, Booktopia, etc. And I want to thank you guys for making my book #1 in the real estate category in Amazon. Thousands of copies have been sold. It took me 10 years to write this book, guys. It's a very, very substantial book, 678 pages, but a lot of graphs, a lot of illustrations and graphs and tables that I'm going to be using today in this presentation that are literally taken from this book. But obviously, I'm only going to cover this topic very quickly. If you want more detail, more information, get the copy of the book because it goes into everything in extreme detail. Now, what I'm going to do today is two parts. Part #1 is I'm going to clarify all the jargon and terminology in finance, because before we get into the strategy, before we get into optimization of structuring, I want to make sure we're on the same page. Now, for some of you, this section will be a little bit boring because you already know all the terminology and all the jargon. For some of you, you have some understanding of some terms, you might not know other terms. For some of you, you don't know anything about finance, it's your first exposure. So you're going to have a great benefit from what I'm about to cover. So even for those who've been around for a little bit longer and you've been in the game and you know this jargon, it's good for you to just listen to this information as well. You might pick up a couple of points, but I want to make sure that everyone's on the same page before we get into the advanced topics, which I think some of you will like. You've never seen anything like it before in terms of how to structure your property portfolio correctly. Whoever said money can't buy you happiness simply didn't know where to go shopping. Very true. So when you think of loan assessment criteria, this is the first thing to do is when you're getting in the market, you've got to get market ready. Well, what does market ready mean? It means that you've been to a mortgage broker, you've got a funding proposal in writing saying, congratulations, John, you can borrow $880,000 from the following three lenders, Macquarie, ANZ, CBA, and this is the interest rate, right? So you've been pre-approved, so you know how much you can spend, and you've got the deposit and closing costs, accessible instantly. So you got either a line of credit set up, a redraw facility, or you've got cash in bank sitting there. So you can draw a check for 10% deposit and you can pay stamp duty. That is your number one goal as a property investor, is to become market ready. You've always got to be market ready, guys. Pre-approved, ready to go when that opportunity arises. Because the worst thing is, and I've been there many times myself, okay? I'm refinancing halfway through, it's weeks away, and I see this amazing opportunity, and it's an urgent, obviously all the good deals, you've got to act quick, so you've got to secure that property instantly, and I miss out on those deals because I'm not market ready, because I can't do a check or a deposit of 10%, and I'm not sure if I can sell the property. So you've got to get market ready, guys, number one. How do you get assessed by lenders? So when you think of assessment, I'm going to give you a quick summary, and there's more of this in my book on finance, and I go into extreme detail in each category. But when you think of assessment criteria from lenders, think of the acronym called SLICE, and think of piece of cake. Now, the SLICE stands for security, location, income, character, and equity. They're the 5 things that lenders look for when assessing your ability to borrow money. And I'm going to cover them very briefly. Now, this is just a very quick overview over each category. Obviously, there is more to lending than this, and there are formulas which I'll cover later on in this presentation. But these are the main ones. Security, residential versus commercial property. What are the different types of security accepted by lenders? So residential houses, even in the worst suburbs, you can borrow up to 95% against residential property. Now, what does LVR really mean? Loan-to-value ratio means the exposure the banks are willing to take against a particular asset. So when the bank's willing to give you 95% against the worst property in St. Albans, for example, they're telling you that medium to short term, that asset can only fluctuate by about 5%. That's what 95% lending really means. So they've already assessed the risk of the property for you. So townhouses, houses, the same thing, 95%. Now apartments, in some areas, you have blacklisted postcodes. If you watch my video on YouTube about buying apartments in Melbourne, you notice there's a lot of postcodes in Melbourne, like Dockland, South Bank, South Melbourne, South Yarra, that are blacklisted, which means you can only borrow 80%, and in some cases, 70% LVR against that property. Serviced apartments are a disaster, don't buy them. Maximum LVR 50 or 60%, and the same with rural property. There's a restriction of 70%, 60% on rural property, depending on the acreage. Commercial property has an LVR of 70%, which really means that in medium to short term, commercial property, especially like now you've got retail is shutting down everywhere, you can have vacancy rates for a long time. So the banks are only willing to expose themselves 70% against the loans. So for $1 million, they'll give you 700,000 as long as you come up with the other 300,000. And the reason they do that is because the number one question the banks ask is, if things go wrong, how can we get our money out of this transaction? So remember the number one rule of making money, Warren Buffett, don't lose money. Number 2, don't lose money. Same with banks. The banks don't care how much they make, it's how much they can recoup quickly when the market moves against them, or when that individual goes bankrupt or the business shuts down. Locations determine LVR. As I mentioned before, residential postcodes have postcode restrictions. Never invest in a postcode that has been blacklisted in the past by lenders. It means that you might be stuck with a property with no ability to get the equity out of the property. The residential metro property is fine. So target properties that are around the median price of every suburb, around the major capital cities. 5 to 35 Ks of the city, but not the central business district itself. It can have imposed restrictions placed on properties within the actual city itself of 80% as low as 70%. Your income is also number 3, which is a very important determining factor of how much you can borrow. If you're a PYG employee, you need 2 pay slips and 2 years tax returns. There are lenders which will do 1 year tax returns, but generally speaking, by having more information, you're opening up yourself to more lenders. Remember, there's 280 lenders in Australia. There's building societies, credit unions. So don't think the whole lending landscape is just 45 lenders because your broker's got access to 45 lenders through an aggregator. There's hundreds of other lenders out there that you might be accessing. So the more information you have as an employee, the better. But really, you need 2 years tax returns, 2 pay slips, and you've got to be past a probationary period. Self-employed, you've got to have an ABN, a GST registered for 2 years. As a sole trader, you need 2 years tax returns. Company trusts, if you're operating through a company in trust, you need 2 years company trust returns, personal financial statements, and directorship distributions of income. So very straightforward, the more you earn, the more you can borrow. Character is probably the most subjective part of your assessment. We're talking about clean credit history. So basically everyone in Australia has a credit file, and which is held currently by Equifax. You can call them up on this number here, 138332, or go into equifax.com.au. And every time you borrow money or apply for an internet connection or a mobile phone connection or refinance, there's a credit file that makes marks on your credit file, directorships, addresses. The less traffic, the better, the higher credit score. The score is out of 1,200. By the way, the score doesn't have any bearing on lending in Australia. That's an American score. And in fact, Equifax got in trouble by ASIC by misrepresenting to the public, and they did an enforceable undertaking, that this 1,200 score is the determining factor on how to get loans in Australia. Remember, in Australia, our banking system is very different to the American banking system. Okay, we have our own credit scoring algorithms that have nothing to do with America. So this is a company that's listed on the Australian Stock Exchange. It's an American company, and their goal is to get you onto a direct debit with them to get access to your credit file. So just understand, it is important, obviously, to have less traffic on your credit file, and every lender looks at your credit file, mainly for loans in arrears, credit card repayments, mortgage repayments. If you were late, you can see the history of your repayments, and you get a tick or an X for paying on time, so you want to pay on time. But, there's more to it in Australia. It's not as simple as just looking at your credit score and saying you're approved. Genuine savings is also important to have, and that's something that a lot of lenders are looking for, and looking at your spending behaviour, basically, and how responsible you are as a person. Equity is how much you're going to put into the deal. Now, generally speaking, if you can come up with a 20% deposit, the banks will give you the other 80%, okay? Because they know that if things go bad, there's enough money in there for them to repossess the property, pay lawyers, pay agents, and still get their 80% back. The moment you go above 80%, which you always should try to do, and you're borrowing 90%, 92, 95, including capitalising interest, you've got to pay for that privilege, and that's called lender's mortgage insurance. Now, in Australia, there's 2 main lender's mortgage insurance underwriters, which is GE and QBE, Genworth and QBE. There's also self-insuring lenders that do their internal insurance for lender's mortgage insurance, and there's also lenders that do what's called a risk fee rather than lender's mortgage insurance. Always go for LMI. It's the cost of doing business. It's tax deductible. Plus, you want to use as much of other people's money as possible. Okay, this whole game is about leveraging other people's money into a growth assets. It's not to save 10%. Because the outcome is you can buy 2 properties instead of 1. And so over 10 years, you save 25 grand, but you could have made $1 million in compounded growth on the other property. So you've lost $990,000 for being a tired ass. So remember, this whole game is about psychology and mindset. The rich use other people's money to make money. The poor use their own money after tax to invest. You can't become wealthy by saving money or saving tax. You become wealthy by leveraging other people's money into growth assets. A very important distinction. You can see that this is the restriction on different properties. So you're starting off with standard suburban houses. You can borrow 95%. Whether you're investor, owner, occupier, right? And as you go down into service departments, the worst thing you can invest, in my opinion, is NRAS. Never invest in a National Rental Affordability Scheme. I was telling people it's going to fail from the day it was launched. Defence Housing Australia, complete con. It's just the worst investment ever. Massive management fees. Properties located in the middle of nowhere, surrounded by soldiers. It's the worst investment. By the way, I've got clients that are soldiers, so I'm all for supporting our soldiers in Australia. I'm a big fan, but I'm saying as an investor, you don't want to buy a house with 500 other houses that are occupied by soldiers and you're the only family living in there. I mean, it doesn't make sense for capital growth, right? These areas are often remote areas. They're not prime areas. And so management fees are huge. There's a guarantee from the government to pay your rent. You don't need rental guarantees, guys. Vacancy rates in Melbourne are less than 2%. What do you need a guarantee for rent? You can't get rentals in Melbourne, in a good suburb. There's a shortage of stock. So university apartments, terrible. And holiday apartments in the Gold Coast, terrible as well. Don't buy them. Service departments are the worst. Generally speaking, this is a genuine savings matrix which also lenders look for. If you're borrowing 95%, you must show 10% in other equity. This is to invest in. Or if you're an owner-occupied, 5% must be saved for a minimum of 3 months. Some lenders 6%, 6 months. If you're going 90%, you need 10% equity in other property. Or you need 5% as an owner-occupied saved over 3 months. And 90%, some lenders will look at that as non-genuine savings as well. So you don't need any savings. See, it's so expensive now, especially in Sydney, to rent. Even high income earners can't save any money because they're spending $1,000, $1,500 a week in rental. So what happens is now, if you're going not 85, by the way, let's continue on. You'll need 5% as an investment, and nothing, really no evidence required on owner-occupied. And 80% where there's no lender's mortgage insurance, you don't need to show anything. Now, because of what I mentioned before, it's so expensive to live in, especially in Sydney. I mean, in Melbourne, it's okay. Brisbane's even cheaper, but Sydney is so expensive to rent in prime areas that even high income earners are struggling to save any money for a deposit. So what some lenders have done is they look at your consistent and rental payments on time, and you can have that as substituting your genuine savings matrix. But also if you're paying deposits, if you've got a term deposit somewhere, shares, and you're contributing regularly, annuities. So as you're building up your equity over time in something rather than parking your money in the bank, they'll look at that as well as a genuine savings. Now let's get into some jargon before we continue on. There's a lot of industry jargon in lending, which is unnecessary and confusing. LVR. I mentioned this before. It's very simple loan-to-value ratio, but I want to make sure we're on the same page. It's simply the mortgage amount divided by the value of the property times 100. That's all it is. So basically, if you've got a house and it's valued at 600,000, you've got a loan for 200, and you've got equity of 400. You divide the mortgage amount by the value of the property times 100. So basically, what you're doing here is dividing 200 by 600 times 100, which is 33.33 LVR, loan-to-value ratio, which means that's the amount of loan to the asset exposure that you have. 33% of the property value is a loan, and 66.66 is the equity position. Very straightforward. Now, equity is based on LVR, but there's two types of equity. There's accessible equity, and there's the actual equity you have in the property. So generally speaking, with equity, we're referring to the amount you can actually take out of the property to use to buy a deposit, bond, or use to put a deposit down, or buy a car or a boat, or do something with. So you can actually take that money physically out of the property. So in this example, you have a $600,000 property, loans 200, equities 400. Okay, so what it is the equity position is based on the current market value of the property minus outstanding mortgage. So equity 600 minus 200 is 400. So the equity position is 66.66. Now the accessible equity will be lower than the maximum equity that you have because you can't draw out all the equity from the property. Okay, so just like with a line of credit is a facility like a giant credit card secured against the equity of your property up to 80% LVR. Generally speaking, accessible equity is up to the 80% mark of your value of the property, less the mortgage. Okay, so in this example, if we go back to one slide, your property value is 600,000, okay, times 80% is 480,000, minus your loan of 200, you've got accessible equity of 280,000 in this property, which means you can take that out as an amount, put it into another bank account or an offset facility, which is probably the best place to park it, 100% offset. So you're not paying anything for it until you use it. And when you're using that money, you pay that money to put a deposit down on the investment property. Remember, guys, when you have cash in the bank account, you never use cash as a deposit because there's no interest on cash, therefore there's no interest that you can claim as a tax deduction. So cash should be always sitting against your property in the 100% offset account, and when you're getting an investment loan together, you have to draw equity out of the property, so you get that interest tax deductible. That way you minimise your tax, maximise your deductions. Now, there's different types of loans. There's what's called full documentation lending, which is full doc, clear history, consistent stable income, full-time employment. And then there's other loans. There's non-doc lending, light doc, credit impaired lending, and pro-doc lending. Now, full doc lending means you're working full-time, consistent stable income, clear credit file, 12-month, 2 years tax returns, 2 pay slips, no credit impairments. Most clients don't fit that criteria. Most people have a variation of that and something that qualify for a low doc. So remember one thing, there's only 2 types of loans that exist: interest only and principal and interest. Full doc, low doc, no doc is not a type of loan, it's a type of loan application. Once again, full doc, low doc, no doc is not a type of loan, it's a type of loan application. It's the level of disclosure that the banks need you to show them in order to qualify for a loan. There's only 2 types of loans: interest only or principal and interest. That's it. I don't know why people overcomplicate this. People think low docs are loans. No, low docs are not loans. It's a type of a loan application. So the low doc refers to the level of disclosure you need to provide, i.e. documentation, to the lender in order to qualify for that particular loan. So low doc loans are where borrowers cannot demonstrate financials to service the debt, however they do in fact earn the income to qualify for the loan. Borrowers must sign a declaration to the lender disclosing their per annum income, however the borrower does not need to present any financials. You can borrow up to 80%. Since the GFC, that was changed now. You need to show financials, you need to show assets, liabilities. So there's no true low docs anymore. This was the definition of low doc pre-GFC. True low doc, 100 points ID, stat dec, you get the loan. It's pure asset lending. GFC came and went, all gone, okay? Now you need self-certification backed up by either an accountant verification, 12 months batch statements, ATO, or 6-month business banking statements. Purchase and refinance, not all low doc lenders will do a low doc refinance, stricter cash out rules, okay? And then harder when you trusts under low doc as well. So you've got to be really working with a good mortgage strategist to understand lending inside trusts, because there are restrictions on trusts. Okay, so you might buy a property in a trust and then you can't get any equity out because you don't qualify for that loan. And then you're in trouble. And then you can't refinance out of a trust, so you've got to sell it, and it means you pay more stamp duty, more capital gain tax. So you've got to make sure you're working with the right people, guys. No doc loans are dead and buried, never coming back again because of the GFC. Thank you, America. This is amazing when this was around. I mean, I did so much borrowing through no docs. It was so good. And they stuffed it up. So no doc is basically where the borrower cannot demonstrate financials to service the loan and does not wish to disclose any income to the lender. Don't ask any questions. Borrower must sign a declaration to the lender declaring that they can afford the loan and it's not going to place them into financial hardship. Can you imagine? Give me the loan, don't ask any questions. No assets and liabilities need to be disclosed. 70% LVR. It was pure asset lending. Okay, so you're out of the equation. If you go under, they'll just repossess the asset, sell it. They don't care. Because you've got 30% equity stake in that property. $1 million property, they give you 70%, you've got 300,000. 300 is enough to repossess the property, pay agents, pay everything, and then still have money left over. You know, so that's what no docs were. Gone because of the GFC and the Consumer Credit Code that was introduced following the GFC by the Kevin Rudd government, never to be coming back ever again. Even if it does come back as a no doc, it's not a true no doc. Now that's the jargon and terminology. Now let's talk about how to structure your property portfolio correctly. Now that we're on the same page, we know all the terminology and jargon. And for those of you who are new, you might want to replay this section a few times, or even get a copy of my finance book, okay, and go through all the jargon terminology before you get to this section here. What I'm about to show you is where the money is. I mean, this is, very few investors are structured like myself. I'm going to show you exactly how I'm structured and how high-level investors are structured in a way where you're maximizing everything, reducing your bad debt, which is your home loan, and then maximizing your ability to get more money to buy investment properties, which is the stuff that makes you wealthy. Optimizing your property portfolio structure. So basically, I want to keep things very simple. And Albert Einstein said, if you know a concept well enough, you'll be able to explain it to a 9-year-old. The red house is a bad investment. It's your owner-occupied property. While it can give you money and can grow, it's costing you money and it's diminishing your borrowing capacity. So you want to pay this property off as soon as possible and accumulate a bunch of these ones. That's why we call these good debts and these are bad debts. This is Robert Kiyosaki, Rich Dad, Poor Dad 101. And you got to understand this psychology. If you don't understand the difference between bad debt and good debt, then you've got to pause this video and then start reading some Robert Kiyosaki books, because it's going to cost you, you've got to have that paradigm shift in your mind. Otherwise, you will fail as a property investor. Good debts are things that put money in your pocket. Bad debts are things that take money out of your pocket. Your house costs you money every year. Yes, I know it's growing in value and you can use the equity, but it's actually costing you money. Okay? It's not producing money for you because you're paying down the loan. While it's appreciating in value, that's fine if you live in a high capital growth area, but not necessarily everyone's house is optimized as an investment property. Where these ones have tenants in them and there's capital growth and there's rental return. The number one thing is you never want to cross-collateralize your assets. They have to be standalone in separate structures with separate lenders. Never cross-collateralize your assets, guys. If your broker's trying to cross-collateralize your assets, run away from them. When I had a mortgage broking company, I would not sign off on anything that is cross-collateralized. I just wouldn't do it. And there's no good reasons to do it either. It creates a lot of complications. Now, once you have equity, you can set up your lines of credit against these properties and then use that money to draw down and buy and build up your property portfolio. Most people, they start off with their house, line of credit, deposit for your first property, and then they never use their house again. They use the investment properties to generate lines of credit to buy more investment properties, which is the right way to proceed, absolutely. The rich control assets, they don't own assets. The poor and the middle class are obsessed with buying stuff in their name. So if you've got properties in your name, you probably haven't maximized things. What you want to do is buy things in trusts and corporate trustees. Now, there are different trusts, and my book has a whole chapter, actually 3 chapters on trusts, written by my accountant. I'm not qualified to give you this information as a mortgage broker or a real estate agent, but I can cover them generically only. But definitely, if you want more information, you've got to read more information or just go to a specialist. But basically, in this information, you have a corporate trustee, a company with 120 shares. I pick 120 because it's the only number divisible by 2, 3, 4, 5, and 6. Acts as a trustee for a trust. You can have a discretionary trust or a fixed unit trust or a hybrid. I choose discretionary ones. I won't get into why because it's another topic, it's another video, but you can look it up. Standalone, and the biggest thing is, so in Victoria, the company ends up on the actual property title, not the trust. In some states, like in Queensland, both appear on the title. The most important thing is if you continue to accumulate assets in your personal name, there's going to be a domino effect if you get sued. And it doesn't need to be your fault why you're getting sued. Australia is becoming as litigious as America. If the more money you have, you're like walking around with a big red target on your back saying, sue me. Okay, so people come after you and they'll sue you. So you want to make sure you own nothing and control everything. So I have nothing in my own personal name. Everything I have is in trusts. Cars, property, I have zero. Because I'm on stage all the time teaching people how to do this. So I don't have any liability. So basically what you want to do is separate the ownership. Now, yes, if you're in IT, and I'm not giving you advice here, but let's say I've got about 80 clients in IT on about $120,000. And IT is the least litigious industry that I've come across. Because you're doing coding, you're part of a team, you're never in the cold face of the public. Probably you're paying about 35 grand in tax. Probably your accountant is going to tell you, listen, buy the first 2 or 3 in your personal name, get your tax down to virtually zero, and then buy in trusts. Now, I've got about 120 GPs and dentists. all of them have everything in trust, including their own home they live in. Or the home is in their wife's name and she's not a medical person. Dentistry, medical field is the most litigious industry in Australia, and that's why the indemnity insurance premiums are going through a roof for that sector. So you've got to get independent advice from an accountant or a financial planner about which structure to utilise. I can only explain it to you from a lending perspective and the benefits of setting up trust from a lending perspective. Remember, whatever gets grouped together dies together. If you keep accumulating assets in your own personal name, you get sued, you lose everything. Now, this is generally the basic structure of a trust. You have a company that's non-trading. Director 1, Director 2 could be your husband and wife. That's the corporate trustee. The appointers are also husband and wife, and the appointer is a very powerful person in this whole equation because they can select the trustee or replace it with another trustee. Then you've got XYZ Trust, which could be a discretionary trust with beneficiaries, and the property settles inside that trust. Okay? Now, generally speaking, you want to have one structure per property. Okay? So one corporate trustee, one trust, one lender. CBA, NAB, separate entity, and then Macquarie Bank, separate entity. If you have them all in one trust with one corporate trustee, whatever you do something to one, you've got to value the others as well. It complicates the whole thing because one trust owns 3 assets. So you want to keep them separate so they're not interlinked in any way with each other, okay? So this is how you optimize your whole property portfolio. Now, I know it sounds complicated when you first see it, but I'm going to explain it to you. It's quite simple. You've got your PPR, your primary place of residence, with $600,000, your red house, which is your bad debt. You want to pay off this property as soon as possible. You've got an interest-only loan of $480,000. You've also got an offset account, 100% offset account, where you park all your wages. Your wages go in there, and the offset account offsets the interest, the principal balance on which the interest calculations are calculated on per day. So remember, interest is calculated daily on the principal balance outstanding, charged monthly in arrears. Now, this is with a pro pack. I'll show you which lenders to go to get this whole structure set up with. Then you get another offset account number 2. It's got a different BSB and account number. And all it does is have the rental from this property go into that offset account. So if this is a property in Brunswick and you're using Changing Places Real Estate to manage this property, you give them the BSB and account number of this offset account to put the actual rent in at the end of each month. Okay, so all the rental goes into these offset accounts and sit there, and these balances offset your bad debt for interest calculation. Now the key is you got to fix your repayments per month. Don't have them variable. You got to fix your repayments, but interest only. So you want to smash your mortgage quickly, 10 years, 8 years, 12 years, not 30 years. Okay. Now here's one of the keys. You've got to make sure that your direct debits that come out of these offset accounts come out on the 1st of each month. Because there's only one 1st of each month, but some months finish on the 28th, 29th, 30th, 31st. So when you're doing your mortgage document application, it's the only time you can do this. So when you're signing your mortgage docs, not the application, when you actually got the docs approved, you nominate your direct debit date, not as the anniversary of settlement, which will be 17th, 18th, 19th. You do it on the 1st of each month. So that way, if you've got 10 properties, you know all your direct debits are coming out on the 1st of each month. So you've got to transfer that money at the end of each month to make sure that it's there to pay for the interest only on those properties. So once again, one corporate trustee, one trust, separate offset accounts, all of them smashing your home loan. I'll show you what the net effect of this is. If you've got a business, you've got to separate the business from this structure through another trust. So if you're a plumber here, ABC Plumbing, you've got your trust set up here away from your wealth building in your house. You don't want any links between these two, okay? Now, I can't explain this in detail. This is a whole hour explanation. Go to an accountant. Very important. Never cross-pollinate your business where you have the largest exposure and your assets. You want to make sure they're separated. Never cross-collateralize your loans, ever, okay? Cross-collateralization is simply when one loan is secured by 2 or more properties. Many clients believe their loans are individually secured or standalone. This may not be the case. There are a few small prints of your loan terms and conditions that you need to consider called the combined accounts and combined security clause. And it's imperative that you understand the meaning of these. The combined accounts clause means the lenders can combine accounts without prior notice, and more concerning is they can involve multiple loan accounts and combining accounting credit with accounting debit, cash with loans. So if your business goes under, you're getting sued, they can freeze your assets, sell your home, which is probably the first thing they sell, rather than investment property, and then give you the balance if there's any money left over. Terrible situation to be in. The combined security clause allows lenders, particularly in guarantee documents, which are applicable to trusts, to combine assets internally. This gives a clause that states that a bank can rely on any security you have provided to the bank. These types of clauses are often referred to as the all money clauses, which you can look up and read about. It's important to understand that there is a legal doctrine of consolidation. That is, in the absence of specific terms and conditions, the all money clauses can be activated at your detriment. The banks don't care about you guys. They will sell you up. So you got 10 properties with NAB in your house, you're an idiot. Never have your assets with the same lender. One lender, one asset, maybe two at the maximum, but never have all your eggs in the same basket. That basket falls, you're gone. 10 eggs, 10 baskets. One falls, no big deal. You'll recover. You won't lose everything and go back 50 years, you know. Now, what's the solution to combating cross-securitization? Number one, you can strike all the all money clause, no chance, they won't accept the contract, or you separate multiple lenders. That's it. Yes, there's a higher cost, more paperwork, and the relationship is lower with the same lender, but this is still how you do it. PPR, investment property, right? And this is what happens is people go to the which bank, they got a house, and they say, oh, I want to buy an investment property. Yeah, sure, we'll give you all the money. What do you mean all the money? Oh, we'll give you 105%. Oh, Konrad and Stephen said you can't borrow 105%. I thought you could borrow 92, 95. Oh, they don't know what they're talking about. I'm here as the branch manager from CBA. I want to look after you. And then you get one property, you go, gee, that was easy. What's all the fuss about? And then you go back to CBA and go, can I get another investment property? Sure, no problem. They give you another one. Okay, this is too easy. There's something wrong here. Can I get a third one? Absolutely. Yeah, here's a third one. And then they turn the tap off and you're screwed. They've got you exactly where they want you. 3 properties cross-collateralized, 1 loan, 4 assets. You're gone now. Now, remember, whenever you do something to one, you've got to value all the others. You want to upgrade your home or do an extension, you've got to value these 3 properties. This property is down 10%, you can't take out this money from this property. Let's say you sell a property here and you make 100 grand. If this property is let down 100 grand, that 100 won't go to your wallet, it will go back to the other property. It's a disaster, guys. Never cross-collateralize your assets. This is what the banks want you to do. This is what I teach people not to do. Okay, it's the opposite. Stand alone. One property, never ever cross-collateralize their assets. A bank is a place that will lend you money if you can prove to them you don't need it, which is very true. Murphy's Law. DSR ratios, debt service ratios. This is the key to understanding of how to build a multi-million-dollar property portfolio and buy 10 properties over 10 years. Now, the DSR is at the heart of, if there is a secret to building wealth through property, and there's no secrets, there's just a lot of information that most people don't understand. There's no conspiracy theory. There's no, rich people don't meet in Brighton at the yacht club every Saturday night and say, hey guys, let's keep these secrets away from the public. But there's stuff that people don't understand. This is one of the things that they use to assess your serviceability. So you have your actual loan repayments divided by eligible joint income. Now, most residential investment properties are interest only. However, when calculating DSR, the banks works out the loan as principal and interest, adds 2% to the annual interest rate. So let's say we're doing I'm using 5%. I know we're getting 2% lending, but let's just lose 5%. It's kind of like the average for the last 30 years, okay? And interest rates will go back up. Not soon, but they will go back up. This won't last, okay? So 500,000 at 5% interest only is 25,000 per annum, okay? Or $2,083.33 per month repayments. The banks converts this to principal and interest, and adds 2%, which is called the benchmark, at 7%, equating to a P&I repayment of $3,533.90. So if you can prove you've got this money here, they'll give you the loan where you're actually paying that much. Okay, because long term, the banks know The average interest rate has been around 7% since the 1950. So they want to work out, can this person pay back this loan eventually? And this is only for internal serviceability criteria, guys. This is how they work out how much money you can borrow. The banks will only consider 30% of your wages towards the repayments of all loans and 80% of your rental income. So if you're making 100 grand from your job income, let's say you're in IT or you're a legal secretary, you're making 100 grand, they'll only take 30,000 of your 100 grand towards loan repayments. Okay, the rest is taxes and expenses because you've got to eat, pay insurance, all that kind of stuff, right? Rents, mortgages. But if you got 100 grand in rental income, they'll take 80,000 of that income. So rent income is nearly 3 times heavier in that equation compared to job income. That's why your whole fuel for your whole property portfolio is based on rental income, not job income. So the DSR ratio is annual loan repayments, which is interest only converted to P&I plus 2%, divided by eligible joint income, which is 30% of your wages, 80% of your rentals. So this is about balancing cash flow positive versus cash flow negative property. Now, all the properties currently that I'm sourcing are cash flow positive from day one because rental yields are 3.75, 4.25%, and cost of funding is 2%. Everything is cash flow positive, all my properties that I'm sourcing for my clients. But when interest rates go back up again at a higher level, what you want to do is basically buy things that are putting money into your pocket after servicing that property. And really, that property has to have a rental yield of around 12% to do that, okay? So if you compare 2 properties at 605,000, if you go to Port Hedland in WA, you can get a property at 605,000 at 12% rental yield. I'm not, by the way, recommending even remotely that you invest any money in Port Hedland, okay, in WA, because it's a mining town, high risk. But I'm saying that these yields exist in these areas. If you go to Doncaster and get a 2-bedroom apartment for 605,000, you get a 4.5% rental yield right now. So I want to show you the internal mechanism for working out serviceability. That's all. Purchase price, Port Hedland, 605, Doncaster, 605. The rent, have a look at that, 72,600, 27,225. Interest only repayment, 30,250 for both. They convert that to principal and interest at 7%, 48,300. Now, towards the repayment, they take 80% of the rental. So 80% of the rental in Port Hedland is $58,080, which is 80% of 72,600. So you have now $9,780 positive income left over, not only to service that property, but any other property you buy. Here, 80% of 27,225 is 21,780, but you need 48,300. So you need to get another 26,520 shortfall from your job income to service this property. Now, if your job income is 100 grand, how much of that will they consider towards loan repayments? 30,000. Will you get the loan? Yes. You just need to be cash flow positive by $1. Now, if you're making 50 grand a year, 30% on 50 is, come on, this is hard, year 7 maths, 15,000. Will you get the loan? Computer says no. Why? Because you failed to meet the minimum criteria. That's how the banks work out your serviceability. So you've got to focus on, important conclusion, a balance of cash flow positive versus growth properties if you want to balance your portfolio and you have low income. If you have high income, buy growth properties, get rid of your tax to zero, and then consider balancing your portfolio. But roughly, for every 2 cash flow positive properties, you can afford to own 1 growth property as a long-term strategy, okay, where you don't have to be relying on your job income. It's a very powerful thing. And once again, you structure them standalone, separate lender, preferably in trusts. Now, what do I buy first? If your income is under 50 grand and you're paying 32.5% tax, buy cash flow positive property first, because then you can buy another one instantly. If you're over $80,001, you're paying 37% tax, buy negatively geared property, growth property basically, and then cash flow positive. If you're between 50 and 80, need more information, car loans, credit cards, that kind of stuff. Okay, final section, owner occupied. This is how we get started, as I mentioned before. Let's say you got a house for 500,000, you get a loan for 200, okay, and then you've got equity of 300,000, and you're buying an investment property. So what you do is you refinance that, you get a master facility of 200,000 through an equity withdrawal or line of credit, whatever you like, and then you buy your investment property by writing a check from this property equity release into this solicitor's trust account. Okay, so your 500,000 investment, you have 50,000 deposit, 10%, and then you have also stamp duty and legal is about 25, and a loan of 450. Never are these two properties to be cross-collateralized. Separate lender, guys, separate lender. I know it sounds like a broken record, but it's so important you get this from day one, because if you cross-collateralize your assets, you're going to be in the world of pain. Okay, now the best lines of credit from last year, Bank of Melbourne, St. George, portfolio loan, Macquarie Premium line of credit, Westpac Advantage Pro-Pack line of credit, ANZ Equity Manager, Suncorp Asset Line, AMP Pro-Pack line of credit. The key to understanding money is to understand this, which is very difficult to understand. I'm going to go through it anyway. You might want to play this section over and over. Interest is calculated daily on the principal balance outstanding, charged monthly in arrears. Interest saved is better than interest earned. Now, this is your primary place of residence. Okay, you got a mortgage here, and then you got an offset. Now, an offset account simply means whatever money sits in the offset account reduces the balance on interest calculation for the day on your other account. They're just simply linked. Now, an offset account is not a loan, it's just a transactional account. So if you've got a mortgage here of 500,000 and you got an offset balance of 100, it means at the end of each day, your balance for interest calculation is only $400,000. That's all it means with 100% offset. So if you were to park 500 here, this repayment will go down to zero. There'll be no repayment on your mortgage. So what you want to do is set up an offset account against your mortgage balance, link them together. You have a credit card, 44 or 55 days interest free, okay, and then you use that to live off. Want to make sure you've got ATM access, checkbook, online banking, direct credits and debits. You set up all your direct debits on your credit card, Telstra bills, gas, water, council rates, everything, okay? Question everything, but have everything on direct debit because it will affect your credit score and your credit file. Salary and wage into your offset account, and same with your rentals. Now, your rentals don't go into the same BSB and account number, and tax returns, obviously. They go into separate ones. And this is the key to understanding how to unlock equity from your house and how my clients are building 10 properties over 10 years, is getting these lines of credit to buy these properties and keep accumulating wealth. And eventually you can sell half, pay off the other half, or buy 10, sell 6, pay off 4, buy 7, sell 4, pay off 3. You lose 1 in capital gain tax. Or just keep accumulating them and become cash flow positive. The key is to make sure they're always standalone. You don't want to cross-collateralize your assets. You want to keep things separate, and you want to make sure your deposit money always sits in an offset account and you're getting equity out to buy investments. Okay. You also want to make sure that with your offset accounts, these rentals don't go into the same BSB and account number. You want to make sure that these rents go into different BSB and account numbers. So there's no cross-pollination between these two properties. Let's say this is Brunswick, this is Elwood. Different BSB and account number. Because if you print this off at the end of the year for your tax returns and they're all over the place, you won't be able to work out which is which expense is associated with which property. So you want to make sure that you manage this from day one. So once again, you have your offset account, you have your salary and direct wage crediting, credit card linked to that one, and then you have your rent and deposits linked to 2 other accounts. Now, that's why you got to use a Pro-Pack, which is a type of loan that exists with specific lenders. And this is the key behind automating this structure here. Because once you automate it, you don't need to do much with it. It just runs itself. All you got to do at the end before the end of each month is to transfer money into these offset accounts from your master account to make sure you're meeting all your direct debit requirements for every loan that's associated with owning every property. Now, These are the best packages. There are different, there are 57 banking packages available from 29 institutions, and they're all very different. There's advantages, there's convenient banking, streamlined fees, no annual fees and gold cards, the reward programs. They're all slightly different, but these are the best ones. The CBA MAV package line of credit, or the wealth package as it's called. RAMS has one, okay, which is the Smart Way Professional package. Westpac Premium Advantage package. St. George Advantage Home Loan package. Suncorp, which is the Money Manager asset line. ANZ, which is the one I'm using currently, which is the Break Free package. It's a very good, and the software with ANZ is probably the best on the market, I would say. NAB with the Professional Property package and Tailored Home Loans, and there's many more. The traditional ones are these ones. So you got the Break Free package, Wealth package, Choice package, Premium Advantage, and Advantage package. These are the best ones. If you don't know where to get started, just go for the majors. Go for the major 4. Go in there on a Tuesday and pick their brain. They'll explain to you how it works. Yes, you get discounts of variable rates. Now variable rates are so low, there's virtually no discounts applicable, but historically you had discounts of up to 0.7, 0.9% of the standard variable rate, depending on the lender and your situation and how much you're borrowing. And also you get perks and benefits of discounts on home and contents insurance, things like that. But generally speaking, the Wealth package was the first one to market. Then NAB came out with the Choice package, then the Break Free package and the Premium Advantage package. They're all pretty much the same. Investigate them further. This is your key distinction. You've got to know how these work when you're building your wealth through property investing. If you haven't got one of these packages, you've done it wrong already. You have to investigate this further, guys. I'm telling you, this is going to save you so much money over time, because this is the key of smashing your home loan in record time. So without these packages, you can't do it. Without offset accounts or lines of credit, you're going to be stuck, So remember, lending is not about the lowest interest rate. It's the highest level of flexibility. That's who wins, not the interest rate. Now, how do you set up your loan structure, just to finish off? So you set up your loan, principal home loan on your house that you live in, interest only. Interest only. Set the monthly repayment the same as the principal and interest loan. Any surplus sit in the 100% offset accounts for 30 days. This essentially is making additional monthly repayments on the loan as park funds sitting in the 100% offset reduce the total interest amount that is payable each month. Because remember, interest is calculated daily on the principal balance outstanding. So if you got a loan of $500,000 for 25 years and you just put another $100 extra in contributions every month, right? You save 1 year and 6 months and $27,352 in interest over the 25-year loan. If you make an additional $200 extra contribution, which is just parking rental money in an offset account, you save 2 years and 11 months and $50,765 in interest repayments over the life of the loan. $500 extra on the $500,000 loan over 25 years, 6 years and 2 months, that's huge, and $104,608.17 in interest repayments, massive. And the $1,000, which could be 2 rentals of 2 properties, or 1 good one, check this out, 9 years and 9 months, and $162,409 in interest repayments. So you pay off your home here instead of 10 years nearly in saving, 9 years, 9 months that you saved. Because remember, it's not how much interest you pay on the loan, it's the interest that you pay over the life of the loan that matters. So let me give you an example. Let's look at this, a couple, both of them are 60 grand per year, PYG, right? Just employees, one works at a supermarket, one works at a post office. And what will happen to them if they park their fortnightly money, the wages, in a 100% offset account? So an income of $60,000 per annum, PYG, you end up paying a total of $11,847 in income tax and clear $926.02 per week, or $4,012.75 per month each. So you multiply by 2, which you get $8,025 combined. Now, remember, on the $500,000 home loan over 25 years would cost you $2,083 interest only per month, or $2,922.95 principal and interest over the month, okay? So it will look like this. If you did interest only, you never pay the principal. That's why people don't do interest only. They think, well, I want to pay the principal down. You can still do interest only and make additional repayments in order to repay the principal balance outstanding. Okay, so interest only is 2,083. Interest, principal and interest is 2,922. And the net effect of that is, this is your amortization schedule over 5 years. Now, let's look at an example where the couple's salaries are direct credited to the mortgage left for 44 days while the couple pays all the bills using the interest-free credit card. So this is where you're turning the table on the banks using their money for free to pay your living expenses, and then before the interest is actually charged, you pay down the credit card to zero. So you never pay any interest on it. It gets paid completely by the money in the offset account. And you can set this up as a mechanism. It's called auto-sweeping. So the couples makes $8,025.50 net, after tax. The mortgage repayments are $2,922.95. The living expenses are $3,000 per month. So they've got savings or discretionary lending of $2,102.55. Now, where was the best place to park that $2,000? Against the mortgage in an offset account, right? Until they need it. So in this example, they can pay off the home loan within about 11 years instead of 25 years. So this is the net effect. The original one was interest, 25 years, and they're paying $376,885 in interest because they're paying 25 years of the loan. New scenario, 10 years and 9 months, $147,010 in interest, which they're saving $229,775 in interest at 14 years and 3 months. How long would it take a couple to save $229,775? And that's after-tax money. Do you know how long? A lifetime. And this is why Australians end up dead broke at 65 with one house, because they take 25 years to pay it off because they think they got the best interest rate, and they do principal and interest repayments. You should only do interest only and make the additional repayments based on the amounts that are in your offset account, and smash your mortgage from 25 years down to whatever you make, contributions, 15 years, 12 years, 10 years. The more you put in, the quicker your mortgage gets paid off. And this is the crazy thing. If people just understood this, do you know how many days they got to work? 14 years and 3 months they got to work in addition. Driving to work in the morning, having breakfast, battling traffic. 14 years for the banks. It's almost like you can't even think about it. It's crazy. Any questions about finance? Don't send me questions because I'm not allowed to talk to you about finance. You've got to go to a qualified mortgage broker. Even though I've got a diploma in financial services and mortgage broking, I'm no longer acting as a mortgage broker. And that's why this was purely just an educational exercise to show you how to structure and optimize your property portfolio correctly. So the key with all this information is the whole structure of your property portfolio should really look like this diagram here, and you should be able to explain this to people. You've got your home loan, you've got your interest-only loan, offset accounts, investment properties, all standalone, separate lenders, never cross-collateralize your assets. This is your engine that will smash your home loan in record time, and then you can focus your energy on accumulating growth assets. And growth assets are what's going to make you money. Remember, it's about controlling assets using other people's money. This game is all about leverage, guys. Leverage, not paying stuff down, which is what people have taught you for some reason, which I don't know why. Pay things off. You never pay things off. You can pay things off by selling others. You don't pay down the principal of a property. That's the lowest use of your time. Now, for those who are interested, you can book in a 60-minute strategy session with myself. I'll do a whole wealth strategy with you based on property acquisition. So we do an idea, we do a plan, and I'll show you how you can put that into action. It's 60 minutes, and we develop a unique strategy based on your set of circumstances and your financial situation. Remember, if you fail to plan, you plan to fail. You've got to have a clear plan, clear starting point, clear destination, and then you've got to know how to re-engineer that backwards into property acquisition. Most people spend their lifetime doing this, going from A to B like that. What I'll do is I'll show you the path of least resistance. So it's 1 hour, and I'll go through the whole plan with you. You also get access to my whole network of experts if you need a good financial planner, accountant, mortgage broker. I've got the best ones in Melbourne, lawyers, quantity surveyors, insurance specialists, everyone. The whole purpose of this is to show you how you can build wealth using townhouses and detached houses as a wealth creation vehicle in Melbourne's top 50 highest capital growth suburbs. Honestly, just to get the network is worth getting into contact with me, because if you get access to these lawyers, accountants, they'll make your life a lot easier. You've got to have a strategy, guys. Without a strategy, there's nothing. Strategy is the key to making money. And this is a step-by-step, paint-by-the-numbers system. There's very little interpretation, very little thought, creativity involved. How do you qualify? As an individual, you've got to have an income of at least $95,000, access to about $112,000 equity, so you can at least buy a $700,000 property. I don't have anything under $700,000, guys. Very rarely do I have anything under $700,000. Couple about 120, 140, and about $112,000 in accessible equity. And then that's it. All you got to do if you've been to a live event is send me this form. Or if you haven't been to a live event, you're just watching me for the first time on YouTube, just email me directly, conrad@investorsprime.com.au, and just put, complimentary 60-minute strategy session with Konrad Bobilak requests. And I'll just reply. You don't need to write essays about your situation. If you do have investment properties, if you want to attach something with your current structure or current mortgage balances, interest rates, feel free to do so. If you just got one house, you're starting out, we can cover that on the 60 minutes, not a big deal. These are free sessions, no strings attached. I only do 10 of these per week, and I do get booked out. There's a bit of a waiting list now for 3 weeks. So first in, best dressed, guys. And thank you very much. I hope you enjoyed this video. I hope you subscribe to my YouTube channel. The more subscribers I have, the more content I'll create. And thank you very much for your time. This is Konrad Bobilak, and I'll see you on the inside.